If you somehow thought that this was one of those far-off arguments in Washington that has no impact on you, you may want to know this if your home isn't paid for. If there is no agreement on the debt limit, interest rates on U.S. financial securities will go up, and that means so will rates on adjustable mortgages. Dean Reynolds has more on that now.
I just reached it where I'm qualifying.
Juan Cruz says Congress is messing with his American dream. He's made an offer on a $130,000 home for his young family and hopes to get a 30-year fixed-rate mortgage at 4.5%.
I'm trying to stay within my means. But if it goes up, if the percentage rates goes up, then it affects my outcome.
Rate increases are nearly certain if Congress cannot reach a deal and the U.S. defaults. Juan's bank told him interest rates could rise 2 percentage points, which would jack up his mortgage payments $163 a month.
Do you think Congress gets that?
I hope they get it.
In Evanston, Illinois, landlord John Nash is in an even more precarious position. With an adjustable mortgage on a building he rents out, he's bracing for a several $100 monthly increase in payments if the stalemate in Washington persists.
My concern is that the rates would go up tremendously, which would put an added expense on me as a small real estate investor.
You can extend that concern about higher payments to an estimated 15 million homeowners with adjustable rate mortgages. The loans are popular, and why not? For example, a so-called 5-year ARM, in which the rate is fixed for the first 5 years and adjusts annually thereafter, is currently 3.25%, about 1.3 percentage points below the traditional 30-year fixed-rate loan. A sweet deal, as long as interest rates stay low.
Now, housing and real estate have been the biggest drag on the U.S. recovery. So, Bob, you can see why so many people worry that default would slow things down even more.
All right. Thank you very much, Dean. Dean Reynolds out in Chicago.